Your bank account says zero. Again, you've checked 3 times today, and the number hasn't moved, but something in your chest has. This is where the story starts. Not with a stock tip, not with a formula, not with someone telling you to invest $500 a month like that's a normal sentence to say to a person in your position. It starts in the part nobody puts in the highlight reel. Call it phase one. You don't leave it by trying harder. You leave it by surviving long enough to change what the number means. Let's call phase one what it is. Survival. Not a savings phase. Not an investing phase. Every dollar that touches your hands has already been spent in your head before it arrives. Rent, gas. The card you're pretending isn't maxed. In this phase, putting $500 a month into an index fund doesn't feel smart. It feels like a joke from a life you don't have access to. You've heard the advice. Pay yourself first, automate your investing, let compound interest work while you sleep, and you've felt the specific anger that comes from good advice landing on the wrong runway. The person who needs to hear invest $500 a month is rarely the person who has $500 a month. That's the trap. Financial advice is almost always written by people who've already crossed the bridge, describing the view to someone still hunting for it. Here's the turn. In phase one, winning doesn't look like wealth. It looks like a floor. You find $60 where there used to be zero. You cancel the subscription you forgot about. You pick up the extra shift. You sell the thing in the closet you swore you'd use someday. None of it feels like wealth building. It's scraping. But scraping is the job right now. The goal isn't growth. The goal is to stop the bleeding long enough for a future version of you to get a different decision to make. Most people who stall out permanently stall here, and it's rarely laziness. It's phase three thinking crashing into a phase one reality. They try to force $500 a month they don't have. They miss a payment somewhere else. They panic, pull the money back out, and decide investing isn't for people like them. The strategy wasn't wrong. It was borrowed from a phase they hadn't reached yet. The shift out of survival isn't dramatic. There's no montage. It's just the day your checking account doesn't hit zero before the next paycheck lands. That's the whole turning point. Not a windfall, not a lottery ticket, just a gap. A small, quiet gap between what comes in and what goes out. Most people don't even trust it when it happens. They've spent so long in scarcity that they keep bracing for the gap to disappear. Call this phase two, stability. It's the strangest phase because from the outside, nothing looks like it's happening. There's no dashboard climbing. What you have is $100 in checking that didn't exist 6 months ago. Then it's $1,000. You open a savings account, not because a guru told you to, but because you finally have something that needs somewhere to sit. This is the first moment $500 a month enters the conversation as something other than a fantasy. Not because you have it yet, because you can suddenly imagine a version of your life where you might. That imagining matters more than people give it credit for. Money decisions aren't made by spreadsheets, they're made by identity. In phase one, investor is a costume that belongs to other people, richer, luckier people. In phase two, you start trying it on in private. You open a brokerage account and drop in $50 just to see how it feels. You don't tell anyone. It's not a strategy yet. It's a test. Are you the kind of person this could work for? And this is where a lot of people stall. More quietly than phase one, which makes it more dangerous. The phase one stall looks like crisis. The phase two stall looks like comfort. You've stopped drowning and not drowning feels like arrival. So you relax. You upgrade the apartment a little. You upgrade the car. Nothing bad happens. That's exactly why this stall is so easy to live in for years. You're not in danger. You're just not moving. The way out isn't more discipline. It's a decision to treat stability as a starting line instead of a finish line. This is where $500 a month stops being absurd and starts being uncomfortable but possible. You run the numbers almost as a game. What if the money moved before you saw it, the same way your rent does? You're not committing to a lifestyle yet. You're testing whether the gap from phase one can become a habit instead of a fluke. And slowly, without any single dramatic day marking it, you cross into phase three. This is the phase people picture when they imagine building wealth. It doesn't feel like the imagined version at all. It feels boring, and that's the tell that you're actually in it. In phase three, $500 a month stops being a decision you make every month and becomes a decision you made once. It's automated. It leaves your account the same day your paycheck lands before you can invent a story about why this month is different. Here's the part that would have sounded insane back in phase one. It doesn't hurt anymore. Not because you have dramatically more money. Plenty of people in phase three aren't high earners. Your relationship to the number has changed instead. In phase one, $500 gone meant $500 you needed. In phase three, $500 invested means $500 doing something, somewhere, while you go live your life. This is the phase where compounding starts to feel real instead of like a slide in a presentation. Say you're contributing $500 a month, growing at something like an average 8 to 10% a year. Just a thought experiment, not a promise, because markets don't move in straight lines. The first year looks almost embarrassing. $6,000 in contributions, a few $100s of growth on top. And you think, that's it? That's the whole magic of compounding? Yes, that's it. Nobody shows you this part because it isn't exciting enough for a headline. The first few years of phase three are the least visually impressive of the entire journey. And they're also the years that determine everything after because they're the years where the habit either survives boredom or doesn't. This is the second major stall point, and maybe the most common one of all. People start phase three with real excitement. They finally have the gap, the automation, the identity of someone who invests. Then year two arrives and the number looks almost insultingly normal. They expected the graph from the YouTube video, the one that goes vertical. Instead, they get growth smaller than what they spent on takeout. So they stop. Not dramatically, not like a phase one investor panicking out. They just quietly reduce the contribution for now. They tell themselves they'll bump it back up when things settle down. Things rarely settle down on their own. What actually breaks the stall isn't more information about compound interest. Most people here already understand it intellectually. What breaks it is time acting as proof. There's a specific month when you check the account and realize the growth this year was bigger than everything you contributed. That's the moment the abstraction becomes real. It usually lands somewhere in year 6, 7, 8, later than anyone wants to hear, earlier than most people expect once they're actually living it. Here's what's happening underneath the boring surface. Your $500 a month is becoming a smaller and smaller share of the total growth. In the early years, almost all the movement comes from your own contributions. You're doing the lifting. But somewhere in the middle of this phase, the balance shifts. The market's growth on the money already sitting there starts to outweigh what you're personally adding. This is what people mean when they say money starts working for you. It isn't mystical. It's just math catching up to patience. By the time your account sits around $60,000 or $70,000, one strong year can add more to your net worth than an entire year of contributions did when you started. Nobody feels this happening in real time. You only see it in hindsight, scrolling old statements, thinking, wait, when did this start moving on its own? That recognition pulls you into phase four. Call it accelerating. This is the phase where net worth stops being something you build and starts being something that builds itself, with you as maintenance crew instead of sole engine. Phase four doesn't require you to change your behavior at all. You might still be contributing the same $500 a month you automated years ago. What's changed is the size of the machine that money is feeding. Somewhere between $70,000 and $100,000, most people cross an invisible line where a good year's growth can rival their entire annual salary's worth of contributions. The arc that took 8 years to build the first $50,000 might only take 3 or 4 to build the next $50,000, not because you tried harder, but because the base got big enough to carry the weight. The earlier phases start to look unrecognizable in the rearview mirror. The version of you deciding between groceries and gas wouldn't believe that the person in phase 4 can glance at a $4,000 market dip and feel mild annoyance instead of panic. Not because that person is braver, because that person has watched the number recover before. They have data instead of fear, a track record with themselves that phase 1 never had time to build. The strategy is still on paper identical. Put money in consistently, leave it alone, let time do the rest. But the psychological experience of executing that strategy is almost a different activity, depending on which phase you're standing in. And this is really the whole story, isn't it? Not the dollar figures, but the fact that one instruction, invest $500 a month, gets asked to perform 4 completely different psychological jobs. In phase 1, that instruction is cruelty dressed as advice because the money doesn't exist, and pretending otherwise breeds shame instead of progress. In phase 2, it's a hypothesis, an experiment tested with money you can afford to lose. In phase 3, it's a discipline, unglamorous enough to make you question whether it's working at all. In phase 4, it's barely even a decision. It's just what you do, the way you brush your teeth. Except this habit is quietly worth more than your car. Most people don't stall because they lack a strategy. The strategy has been sitting in plain sight the whole time. Spend less than you earn, invest the difference, let time compound it. Repeat. Every stall in this story happened because the mindset required for the next phase hadn't caught up to the money required for it. Or the reverse, where the mindset was ready but the person kept applying phase 1 panic to phase 3 progress. Checking daily, expecting drama, quitting the moment boredom set in. The bottleneck was never the $500. It was whether the person believed, in their bones, that they were the kind of person this was happening for. So if you're sitting somewhere in this story right now, and you are because everyone watching this is somewhere in it, the real question isn't, how do I get to $100,000? It's this: which phase are you actually in? Are you forcing a phase 4 strategy onto a phase 1 life? Or dragging a phase 1 fear into a phase 3 reality that's already working? The sequence doesn't skip. There's no version of this where you leap from survival to acceleration without walking through the boring middle. The years with no montage, where the account barely moves and the only thing compounding is your own patience. The $0 doesn't turn into $100,000 because of a single decision. It turns into $100,000 because a person who once felt like investing was a fantasy became slowly, without ever noticing the exact day, a person for whom it was just Tuesday. That's the milestone hiding inside the number. Not the $100,000, the version of you who finally stopped being surprised by it.